All right, good morning. Welcome everyone to our session on deficiencies for private fund advisors. My name is Craig Moreshead. I'm from Fourside. Pleased to be joined by Curtis Flippen, my colleague from Fourside. If we could do the next slide, just to give you a brief background on Fourside. This will be the only sales pitch during the presentation. Give you a little high level of our firm if you're not familiar with us. We have over 2,200 clients, 30 plus service offerings, almost 300 employees. Fourside pairs best in class technology with comprehensive advice to help all of our clients in their investment management practice. We have a full suite of outsourced consulting solutions and platform-based model for broker-dealer and registered investment advisors to help them simplify their compliance programs. Fourside also operates 17 affiliated broker-dealers that distribute over $1 trillion worth of product. We have headquarters in Portland, Maine, and offices in New York, Boston, Columbus, Milwaukee, Wisconsin, and other regional locations. Next slide, just brief intros. So you can see us live on the screen, thankfully, but here are our photos. Again, Craig Moreshead, I'm managing director. I head up our investment advisor consulting practice at Fourside. Been working in this industry for 25 plus years, an attorney as well. Prior to Fourside, I was in-house counsel for Lincoln Financial Group. And joined with me, pleased to introduce Curtis Flippen. Curtis is senior director at Fourside, also an attorney. He provides full service compliance consulting to SEC registered RIAs, primarily private funds and institutional advisors. Curtis has more than 20 years of experience. And prior to Fourside, Curtis was with Prudential, MetLife, Deloitte, Bear Stearns, and Ernst & Young in a variety of compliance and legal functions. So in terms of the agenda today, next slide, just briefly, we're going to be covering four main topic areas where we see a lot of deficiencies in our private fund clients. First, we're going to cover the compliance program and errors, issues we see in compliance programs. Second, conflicts of interest, of course, is a very hot topic and covers a wide variety of subtopics as well that Curtis will get into. And then I'll be talking some about fees and expenses. Probably the biggest area we see deficiencies in SEC exams, and also regulatory filings, specifically Form PF and Form ADV. Our approach today as a consulting firm, we're going to be talking a lot about the issues that we see, both when we do exams of our clients and when we help navigate our clients through SEC exams. But we're also going to be focused on giving practice pointers, both to avoid these type of issues in your firm, as well as, once they're discovered, how some tips to help you remediate those types of issues. Certainly welcome questions as we go. And so with that, I will throw the first section over to Curtis to talk about compliance programs.
Thank you, Craig, and hello, everyone, and thank you for joining. So, I want to spend some, couple of minutes just setting the table in terms of deficiencies and, how compliance program helps to remedy or lessen the likelihood that you receive a deficiency letter. So first, I'll say that in my experience, there is no foolproof method to eliminate a finding of deficiencies or weaknesses by the SEC's Division of Examinations. But there are roadmaps, otherwise known as risk alerts, available to us to reduce the likelihood of a finding at the conclusion of an examination. Second, I'll say that I think the most effective way to reduce the likelihood of receiving a deficiency letter is to understand that SEC exam readiness, as I call it, or said another way, putting your firm in a position for a positive exam outcome has to start long before notification from the SEC's Division of Examinations. And two, that this means managing and operating your firm's compliance program on a day-to-day basis as if an exam was going to happen the next day. I call it a constant state of readiness. Third, this is about alignment because we're really not that far apart between the examiners and what we're trying to do in our day-to-day in our compliance programs is generally the SEC examiners seek to determine whether the advisor is conducting its activities in accordance with applicable federal securities laws and rules, whether the advisor is adhering to the disclosures it has made to the SEC and investors, and whether the advisor is implementing and following its written compliance policies and procedures that are designed to reasonably ensure that the advisor's operations are in compliance with the law. Now, I am sure this is all familiar to you because as investment advisor compliance professionals, we are focused, generally speaking, on the same things in the day-to-day operation of our compliance programs. So, with that, I feel like the table has been set and kind of just want to give us a framework to operate under. Now I want to go in and talk a little more specifically about common issues and deficiencies that private fund advisors experience during SEC exams and practice tips to avoid them. I should say also what you're looking at are essentially my thoughts somewhat boiled down into for presentation purposes. And what that means is I'm sort of talking through everything you see on this page, but generally in this order, but I'll say left to right: deficiency roadmap to forgotten set of policies and procedures, and then proper policies and procedures. So left to right, just give you that as a note, but I'm talking through all of it, I promise you. First, our second first, what are some ways to keep our compliance program in a constant state of readiness? I think the first thing is dealing with what we know. And what we know are, or what we should do, I recommend and always advise on, is take note of the SEC roadmaps, that is risk alerts, as a means to periodically self-scrutinize deficiencies or weaknesses in your compliance program and to continually align your program with the interests of the SEC. So for example, February 2017 roadmap or risk alert, the SEC highlighted, among others, this isn't everything, compliance manuals are not reasonably tailored to the advisor's business practices. Compliance manuals are not current. Advisor does not follow. This is huge and comes up quite frequently. And I really don't believe it should if we're doing the things that we should do. Advisor does not follow compliance policies and procedures. More recently, in a November 2020 risk alert, the SEC cited as common deficiencies or weaknesses, evidence of annual review, meaning that there's no evidence that an annual review was completed. And there's, they also said identification of risk. This to me speaks to the value of establishing and actively maintaining your inventory of compliance risk and conflicts of interest. If we look at things historically, that's where your compliance program is built from, your inventory of compliance risk and conflicts of interest. I'll say the other thing the SEC specifically asked, this is another known. We know in the SEC's information request, in a routine examination, the SEC is going to ask, it's going to say something, the information request will say something like, please provide us your inventory of compliance risk that forms the basis of your compliance policies and procedures. We know that, and that the reason for that is we are in the business in compliance. I'm stating the obvious, I know, but of identifying and mitigating or eliminating conflicts of interest. And once you identify a compliance risk or conflict of interest, we know the next step is to put in place policies and procedures to mitigate those compliance risk and conflicts of interest. I think you choose not to follow these roadmaps at your firm's headline and monetary risk. There are specific roadmaps for private funds. So I just kind of went over the broad, private fund advisor is an SEC registered advisor. So there are going to be what I'll call core deficiencies and weaknesses that we are trying, building our program to get in front of and operating our program on a day-to-day basis. And there are also, as we know, the SEC has highlighted specific deficiencies and weaknesses that they find continually in private funds. So we know in the June 2020 risk alert, the SEC highlighted, and it was nice about this aptly named investment advisors managing private funds. They highlight conflicts of interest. I'm going to discuss a little in greater detail below. Policies and procedures relating to material non-public information. More recently, in the Division of Examinations, I guess we all caught that it's no longer OC, it's now Division of Examinations. In their 2021 exam priorities announcement, it was stated that the division will focus on, among other areas, material impacts on portfolio companies owned by the private fund. So real estate related investments due to recent economic conditions, portfolio valuations, and the resulting impact on management fees. Or, something like, is there any activity suggesting that the portfolio valuation is somehow being elevated while there's fundraising going on? None of us would do it intentionally, but we have to make sure that we're not. Conflicts around liquidity, such as advisor-led fund restructurings, including stapled secondary transactions, where new investors purchase the interest of existing investors while also agreeing to invest in a new fund. I guess I'll say that I say all of this because these deficiencies are out there, these roadmaps are out there. What we do with that information is a big a determining factor as to how how things will work out in terms of handling an SEC inspection. So all of this to say that we should utilize these roadmaps to reduce the likelihood of receiving a deficiency letter by baking the roadmaps into our monitoring and testing to limit risk exposure and weaknesses. What are ways that you can bake these risk alerts into your monitoring and testing? One thing I do is break the risk alerts down into a spreadsheet and conduct a mapping exercise to assess where the firm stands in terms of these risk alerts. And this aligns with continually, no compliance program is static. So if we're going to be in a constant state of readiness, we have to continually take advantage of all inputs that help us or position us to be in a better position for when the SEC comes. So if constant state of SEC readiness sounds a little bit overwhelming, I don't mean it to mean a stressful thing, but I mean that we bake it into the DNA of how the program operates by taking advantage of information that is made available to us. So also, and this gets to regular periodic self-scrutiny. All right, so the big takeaway is the compliance program is the basis of and is the most effective way to limit or reduce the likelihood of receiving a deficiency letter. Craig, do you have any comments or anything? I'm going to get ready to go to another section, but before I do, just want to know if you want to
Sure.
jump in with anything.
Yeah, I would just have three quick points to add. First, I've seen the SEC will certainly evaluate the effectiveness of the CCO themselves in their exam. And,
Mm-hmm.
in private funds, typically the CCO is wearing many hats, probably spending a minority of their time on compliance. And
Mm-hmm.
you want to make sure that the firm has adequate resources dedicated to the compliance program. So whether that's having outside counsel, a consulting firm like ours available, and also making sure that the CCO has adequate time to dedicate to that role. Second, I would say side letter management. We have seen the SEC review, especially firms that have a multitude of side letters across their investors. They're going to want to see some controls and oversight in place to make sure that you're effectively managing those side letters. And then
Mm-hmm.
third, I would say it's really important to have a third party evaluation periodically. You don't have to do it every
Mm-hmm.
year, but I would say probably the firms that I've worked with that have had the biggest issues are ones that for years have been plodding along, doing things by themselves, flying solo, so to speak, without any third party assistance. And so I'd really encourage you, maybe once every year or certainly every 2 or 3 years, have a third party come in and take a look at your practice.
Excellent. Thank you, Craig. We're going to jump to now what I call the forgotten set of compliance policies and procedures, otherwise known as fund documentation. And the reason that I want to bring this or emphasize compliance with what we put in the PPM, the LPA, subscription agreement, and so forth is um, I'm seeing deficiencies citing failure to comply with fund documentation. So I'll cite an example. This this is from a deficiency in Q4 2020, and all you have to really look at is ABC's LPA states that all partnership expenses paid by the partnership will be made against appropriate supporting documentation. ABC's PPM states that the fund's target market will be companies. The SEC staff sampled due diligence materials and found that ABC did not comply with its PPM terms. This is also the case above as it relates to the LPA. Takeaway from here is, as a private fund, you enter into contractual arrangements with your investors. I know they're qualified, but it does not, the SEC, no matter whether they're accredited, qualified, or QPs, it doesn't matter. The SEC is still looking to ensure, as I said above, that anything that has been disclosed to the SEC or to an investor that the firm is complying with. So, not much more to say here, but it's the general rule. Whatever we write down, is on deck for the SEC to take a look at. And you yourself, just as as an operating entity, as an investment advisor, are just as more committed to making sure that what you have promised through fund documentation is being complied with. But sometimes where things can go awry, from what I've seen, is valuation. Somehow there's a movement away from what was agreed to in the fund documentation as it relates to valuation, for instance, and somehow you're not valuing as you promised the limited partners in your fund. So you you have your regulatory compliance, Rule 20647 compliance policies and procedures. We all know that we have to make sure we're following them. We can't forget fund documentation and have a process in place procedure in place to make sure that, any disclosures made in the Form ADV, and are there implementing policies and procedures to ensure that fund documentation is being complied with. Takeaway, failure to have an appropriate monitoring program around fund documentation can lead to deficiencies. Craig, I'm ready to jump to another section. Any comments?
Nope, good job. Yeah, let's move to the next one.
Okay, and then this is not breaking news. This is not breaking news, but the proper policies and procedures mitigate and minimize deficiencies. I'll just note, for example, in 2020, a Los Angeles-based advisor's compliance policies failed to account for the conflict of interest presented by having an employee serve on the portfolio company's board, while that employee continued to participate in trading decisions regarding that portfolio company. The SEC found that the advisor did not require its compliance staff. Pause there just for a second. The SEC found that the advisor did not require its compliance staff prior to approving the trades to sufficiently inquire and document whether the board, representative, and members of the firm's team possessed material, non-public information relating to the portfolio company. This resulted in what none of us want: unwanted headlines and financial penalties. Come back to that in a second, but also in the November 2020 SEC risk alert, the SEC highlighted as a common deficiency or weakness due diligence and oversight of investments, including alternative assets. So what is all of this telling us? One, I think, Craig mentioned that what he sees typically at private funds, and I don't disagree with him. There can be there's dual hat. It could be the general counsel and CCO. It could be a CFO, CCO role. And I know the objective is to be lean and mean, worry about, fundraising, getting that anchor investor wherever you are, your next fund. There has to be a commitment to substantive policies and procedures that are, really, and this is the takeaway, tailored to your private fund investment advisory activities, that are, and on a regular basis through annual review and any other monitoring considered thoughtfully. So policies and procedures, as always, carry the day. Craig, I'm moving down probably to the most important part, but do you have any questions, comments, thoughts?
Nope. I think let's go on to conflicts.
All right, I'm just going to finish up on culture of compliance. I didn't put my bullets or sort of the order of this presentation. I mean, really, culture of compliance should be first, but I guess what I'm saying is they're in no particular order because culture of compliance would be first. Culture of compliance, in my view, how that's really dispersed and implemented, or in the DNA of the firm, will probably be the biggest deciding factor of not receiving a deficiency letter, or certainly reducing the likelihood of receiving a deficiency letter. This is in the SEC has stated the most effective defense your firm has against the SEC, investors, plaintiffs' attorneys, and so forth is a strong culture of compliance that is supported by the owners, sponsors, general partners, principals of a private fund, and reinforced through an independent, empowered compliance department. And that was in 2014, and that still exists today. And Craig touched on it above. Role of the CCO, there's a greater chance of limiting deficiencies when the CCO is integrated into the firm's business. E.g., participates in weekly deal meetings, investor due diligence, reviews deal memos, and I mean not brought to the CCO which I've observed at the last minute, tend to be more effective in spotting issues earlier. So integration of the CCO into business investment advisory activities at the inception versus later in the process. And then I just noted here for an excellent reminder on the role of the CCO, Peter Driscoll's notes and CCO empowered senior and with authority in the November 20, his November 20 speech. I'm going to jump down to conflicts of interest. And again, I'll start with the deficiency roadmap. The idea is that, if there are knowns that we can take advantage of in assisting our in the operation of our compliance program, which leads to positioning us for a positive outcome during a SEC exam, it's looking at or acknowledging that there is a long history of the SEC of focusing on how private fund advisors handle conflicts of interest. The seminal case, 1963, which we've all looked at some point, Capital Gains Research Bureau, the court found that an advisor must eliminate or at least expose through full and fair disclosure all conflicts of interest that might incline it, consciously or unconsciously, to render advice that is not disinterested. May 2011, the SEC has for many decades been charged with addressing a wide range of conflicts of interest. And, surrounding all of this is the advisor's fiduciary duty, which requires an advisor that they act at all times in the best interest of their clients, or that they disclose the conflict. And we know in June 2020, there was a risk alert that had a specific section on conflicts of interest at investment advisors managing private funds. And I already referenced that in a core information request in the routine SEC exam, inventory of compliance risk and conflicts of interest. I read it out to you. So what's the takeaway? Conflicts of interest are all around us. We operate in a business that's a conflict in and of itself, managing assets of someone else, because you can take advantage of the assets for yourself. That's the core conflict. And the Advisors Act calls for us, in terms of conflicts, for the firm never to favor itself over investors or the funds. Don't favor one fund over another fund, or investor over another investor, and make sure that everyone, either it's through the case of a private fund, through its fund documentation, has enough information to make a fully informed decision. That's the underpinnings of the Advisors Act, and you can see when you look at it, it's based around conflicts of interest. Private fund advisors must understand their business model and continually evaluate the risk and conflicts of interest that are inherent in the business model to prevent a failure to identify and disclose, deficiencies. If that's not done, then that's going to lead to deficiencies. So again, by the time you get to a deficiency, it's too late. We have to bake in terms of how we go about our business, constant state of SEC exam readiness. To mitigate to mitigate or eliminate conflicts of interest is the question, and really are our only options. Again, we can only do two things with a conflict of interest. You can eliminate it or mitigate it. I'll say it's fair to say that all of us spend most of our time trying to figure out how to mitigate. So what do? We bake it into the compliance program, as you've heard me say, by continually identifying and mitigating or eliminating conflicts of interest. I want to highlight here annual, an active engagement, or at least an annual updating of your inventory of compliance, of conflicts of interest and compliance risk. That is always the start. That's what tells you that I need to add in a new policy or procedure. So really want to encourage everyone to take that inventory seriously and really look at it as the basis from which you really start the process of limiting you receiving a deficiency letter. Other conflicts of interest between the firm and fund investors, compensation arrangements and contractual agreements, conflicts in the fundraising stage, for example, failure to notify investors of the use of a placement agent and then allocating placement agent costs to the investors, conflicts with co-investments by general partners, a firm entering into co-investment arrangement with different terms to those offered to other fund investors. And as you know, and I'm sure a lot of us think about it this way, but in general, you have to follow the money trail, and that's always kind of indicative of where there are hurdles or where things are smooth sailing. Takeaway, as we know, disclosure, disclosure, disclosure reduces the likelihood of the SEC finding deficiencies or weaknesses in your compliance program. And I'm going to hand it back to you, Craig.
Perfect. Okay. Great. Can we go to the prior slide?
Yeah.
So common deficiencies related to fees and expenses. I know there was an alert put out by the SEC a few years back that claimed that over half of their exams, they identified issues around fees and expenses. So certainly something that we test for every time we examine one of our fund advisor clients, and something that you ought to internally be testing as well. I think with fees and expenses, there's really two types of conflicts. One conflict is between the funds and the firm. So some expenses, if the fund pays, that certainly saves the firm expense, so as a benefit to the firm, and a conflict of interest, certainly an incentive for firms to alter how expenses are allocated. The other type of conflict we see is between some funds and other funds, or funds and other types of clients. So if you manage separately managed accounts, how expenses and fees are allocated certainly can benefit some types of clients over others. Common deficiencies, certainly disclosure. The disclosure needs to be clear. I'll get into this a little bit on the next slide, but we've seen cases where the cost of tax services by in-house employees was not clearly disclosed to the funds, and so that was cited in an enforcement action. So clearly that there has to be unambiguous disclosure related to the types of expenses the funds are expected to pay. Failure to calculate accurately, I would include in there not just obviously mathematical mistakes, but basically any instance where the investors have been promised or agreed to one thing and the firm's doing something else. So for instance, we've seen occasions with offsets where certain management fees were agreed to be offset based on, let's say, revenue coming into the firm from portfolio company services. Or there was a case a couple of years ago where there was certain offsets that were promised and not delivered that amounted to over $1 million, and that was not discovered till the SEC came in and do an exam. So, I think accuracy means, doing what's promised and what the investors have agreed to. I mentioned preference of some funds, investors over others. We saw one of the key cases was the Lightyear case a couple of years ago. And Lightyear is a good one to look at. It was an instance where, and it was a pretty common conflict where a lot of the expenses were funneled over to the flagship fund, and co-investors were not charged with those same expenses. And, I think that there are certainly incentives internally why a firm might do that. Flagship certainly has more dollars in it. It's easier to absorb those expenses. But I think, when I look at fee and expense allocation, I think there's really two critical questions you have to ask and answer. One is, are those fees and expenses fully transparent to the investor? That's one question. And two is, are they fair? So I think unless you meet both those tests and standards, I think you could potentially see a deficiency and a problem. I've seen cases where there, in my opinion, there was pretty good disclosure, but there was really no fairness. Take, for example, Lightyear. Lightyear, they did disclose that the flagship funds would pick up those expenses. But the reason they were cited was because they didn't make clear that the co-investment funds and co-investors were not picking up those expenses. So I think your disclosure, if there's a clear conflict, your disclosure almost has to be perfect. So I'd rather be on the side of justifying why I thought an expense allocation was fair than just by trying to make the argument that it was fully disclosed. Just skipping down to utilization of affiliated providers, we see that quite a bit, especially where a firm is using in-house staff for services that are being paid for by the funds. In the example I mentioned before, the tax services, that one, the firm was cited. The disclosure wasn't, there was disclosure that the funds were responsible for paying tax services, but they also disclosure that the firm was paying for staff compensation. So what if you have staff internally that are working on the fund's taxes? And so the SEC obviously looked at that and said, well, there was not clear enough disclosure that those in-house staff working on tax would actually be paid by the funds. In terms of affiliates too, when you think about affiliated providers, really think broadly about any provider where there's a connection to the firm, either through a business arrangement or certainly investment. If there's common ownership, I would even take it so far as to say if there's a related person, let's say you have an executive in your firm and their brother-in-law works for a provider that you've hired for the fund. To me, I think that's enough of a connection that I would want to make disclosure. Why don't we move to the next slide? Just some practice tips on fees and expenses. Next slide, please. So, number one, ensure that back one. Ensure that the disclosure is clear and ambiguous, not legalese. In the PPM and LPAs, typically you see a lot of legalese. You want to make sure in your firm brochure, the Part 2A, that the disclosure is clear. Affiliated providers, you want to be conducting almost more due diligence on those than an unaffiliated provider. So, some of our clients will even hire a third party to do an assessment of that provider's services periodically, just to test it out against the market and make sure that the charges are reasonable and that the fund is getting full value for those fees. I think the biggest tip I would say is I don't think firms leverage their LP advisory board enough. And, not that that's a get out of jail free card, but it's almost as good as you can get when it comes to if the SEC came in and challenged how you're handling fees and expenses. To me, that would be the first document I would show them if they challenged how our firm was doing it. If we had made full disclosure to the advisory board. And when you make disclosure, don't just tell them there's a conflict and here, can you approve this expense or fee? You want to really explain what the conflict is and why it's a conflict. So I've seen firms just have real general disclosure that, hey, here's a conflict, can you approve it? You want to really dig in and provide enough of the detail. And certainly develop a clear allocation policy and periodically test it. That policy should get into, testing how we're monitoring who's in charge of making the allocation decisions, and if there's a clear area of conflict, you want to have specific steps in that policy that the firm's going to follow when allocating those fees and expenses. Okay, next slide. Why don't we jump into Curtis? Anything quickly on fee and expenses before we move on?
Nope, keep on. Thank you.
Okay. Regulatory filings. So certainly we're right in the midst of most firms' ADV and Form PF seasons are. March this month for ADV, PF next month. So just want to give some practical tips, some issues that we commonly see for firms when preparing those filings. So on ADV, number one, the item 5 of the part 1, make sure you're not only disclosing asset-based fees and performance fees, which are very common, but if there are any other forms of compensation the firm is receiving, those should be disclosed in both item 5 of your firm brochure as well as the appropriate section. I think it's item 5E of the part 1. Reporting of RAUM and gross asset value. Commonly still see firms that do not include uncalled capital, especially in the gross asset value figure in your items 7B1. So the SEC has told us that RAUM and gross asset value are basically equivalent. So you want to make sure it's not those figures not only include the fair asset values of holdings of the fund, but also any uncalled capital. Reporting under 7B1 versus 2, really you only ought to be marking 7B2 if you're a sub-advisor and the other advisor is reporting under 7B1. If there is another advisor that's reporting those funds, you don't need to do that, but I'd want to make sure and verify. So ask them, but also verify that they're in fact reporting the data for those funds. Umbrella registration is another deficiency we commonly see. So really you have two options. You can either file Schedule R and report as relying advisors, otherwise called umbrella registration. Secondly, there's an SEC FAQ that talks about SPVs not having to disclose relying advisors in the Form ADV. But either direction, if you're relying on that FAQ or if you're submitting an umbrella, there's a requirement that there be a single compliance manual, code of ethics, and CCO that governs both the registrant and any relying advisors or SPVs in your practice. Custody, obviously we still see deficiencies around custody. Make sure you're only reporting cash and securities held under item 9 and that you're verifying PCAOB registration numbers. You can do that right at pcaob.org. And then conflicts disclosure. I think it's item 10 of the firm brochure that probably the most typical area where I see conflicts disclosure related to GP activities, outside business of principals of the firm, or any PC level, portfolio company level conflicts that arise during your practice. Next slide. Thank you. So in terms of Form PF, again, we see a lot of errors typically where firms show one set of data in the PF and then totally different set of data in the ADV. So you want to make sure that your PF ties back to the numbers you're showing in the ADV. The RAUM should be the same. Gross asset values should be the same. Net asset value obviously is not an item requested in the ADV. So that's separate and apart for the PF. But Make sure that those items tie back and the PF is consistent with the ADV. A fair valuation table should tie back to your audited financials. So for private equity funds, typically all your assets are going to be level 3 and cost based. If you have cash assets would be cost based. Portfolio companies are typically always level 3. Unlike the RAUM, the valuation table should not include uncalled capital. So it's not really an asset of the fund that would appear in your audited financials in that fair value table. Skipping down to investor types, on borrowings, there's some good guidance in the SEC Form PF FAQ that you might want to look at. Investor types, we see issues where firms struggle. Which category should I pick for an investor that maybe crosses different types? Just pick the best one. I would try and avoid the other category if possible. See a lot of firms put a high percentage in other. Try to avoid that. Also on investor types and performance, there's a section where you can add miscellaneous comments. These two areas are typically where we recommend that firms add miscellaneous comments describing both how they determine the investor types, especially for investors that cross multiple categories, and then especially on performance. Performance, you're only required to show annual unless you calculate quarterly and or monthly, then you have to show it. But for funds, how you calculate performance, there are a lot of nuances to it. Most typically is cumulative IRR. But it's really good to add a comment really getting into explaining how you went about that. So in the interest of time, we'll move to the last slide. Curtis, any quick comments? Anything jumps out at you in terms of some issues that you typically see here?
Yeah, I'll go back to valuation. At a private fund, when I was talking about complying with what you put in your fund documentation, my last experience with the SEC evaluating a private fund, the private fund was subject to an SEC routine exam, and they, this is what you say in your fund documentation about valuation. We're not finding a match in terms of how you valued something. So, in a private fund, it's right there. You have made the promises contractually to investors. You have to align with whatever you say and implement and comply with whatever you say in those contractual arrangements. Just remind everyone of that, because somehow private fund, my clients seem to, or some, not all, but will somehow move away from what they already put in the documentation. You can't do it.
Yeah, that's a good point. Evaluation's still a priority. It was listed in the SEC's priority document that they just released. This afternoon, there's a session on the new advertising and marketing rule, which is going to hit private fund advisors in a variety of ways. Specifically, solicitation of fund investors is now covered under 206.4.1. Where it was not previously covered under the solicitation rule 206.4.3. Also, I think for private funds, the SEC requirement for a standard 1-5-10 year performance table may be a challenge for some firms. Fortunately, there's an 18-month runway on the new rule, so you have time, but I would certainly start digesting the rule and the impact on your practice. You'll most definitely need to update your policies and procedures and most likely your advertising disclosures. So we are out of time. I want to thank Curtis for joining me. Again, we're with Fourside. We appreciate your attendance, appreciate the IAA. To me, it's a very valuable conference. They do great work throughout the year advocating for our industry. And just a quick plug this afternoon, there's another private fund focused session, I believe at 1:50, which will include one of the co-heads of the SEC's private funds unit. So certainly worthwhile for you to attend that. Thank you all for your attendance.